Hello friends, today we will talk about financial analysis of financial statements by practicing. I gave you a balance sheet and P&L statements from 2013 to 2016. We will analyze years 2014, 15 and 16 together. With an overview, sales increased significantly, but I can't say same thing for net profit. If you look at the fixed assets, company invested on fixed assets to increase its own sales. I can also say that bank loan rocketed with financial expense together. Why did the company need more debt? After analyzing the financial statements by using ratios, we might find the answers. Is everything going well or something different? For this analysis, we will use four fundamental ratios: liquidity measurement ratios, operational ratios, profitability ratios, and financial ratios. A company liquidity is its ability to meet its short-term financial obligation. Liquidity ratio attempt to measure a company's ability to pay off its short-term debt obligations. We will understand if company able to pay its own short-term liabilities or not. We will start by calculating current ratio. Current ratio formula is current asset divided by short-term liabilities. For 2014, I am faster than the computer. Current asset divided by short-term liabilities, but it must be for 2014. If you look at the 2014, it's almost same that current assets and short-term liability has same amount. It's almost 1. And next year it's decreasing, and after that year it's decreasing more. It means it's a difficult situation for the company to pay its own short-term liabilities. It's recommended that it should be more than 1.5. 2 is very good range, but it is under recommended. I can't say company is able to pay short-term liabilities for this situation. And quick ratio, we will calculate it without inventory. I mean, what if sales stop? Is the company still able to pay its own short-term liabilities or not? Current assets, total current asset minus inventory divided by short-term liabilities. This ratio should be at least 1, but still it's under 1. And the last one is the cash ratio. I mean, the cash and cash equivalent plus marketable security, that we will compare this amount with short-term liabilities. Cash and cash equivalent plus marketable securities divided by short-term liabilities. It should be at least 0.20. But look at the last year. It's 0.04. I can say the company's cash positions or paying to short-term liabilities is not well enough. And the next one is operational ratios. I can say for these ratios that each of these ratios have different input and measure different segment of a company's overall operational performance. But the ratio do give users insight into the company's performance and management during the period being measured. The first one is receivable turnover. The formula is sales divided by average receivable. It shows that how many times per year trade receivables are collected. This is sales divided by average trade receivable. This is 2013 plus 2014 to find the average one divided into and parentheses open and close, and this is 5. Companies turn over its trade receivable 5 times per year for 2014. And to calculate average collection period, you should do that 1 year as a days, 365 days divided by receivable turnovers. Divided by receivable turnovers. It is 73 days for year 14. And next year is more than last year, and the next one is, look at that, it is 86 days. It's increase. This is not good for the company. The collection period is increasing. And what about inventory turnover? It shows that how many times per year inventories are turnovered. The formula is cost of sales or cost of goods sold. I should use minus because it comes from profit and loss statements as a minus. Divided by average inventory. By 2 to find the average one. And to find average inventory days on hand, we should do same thing with average collection period. Like average collection period, 365 days divided by inventory turnover. In 2014, company holded its inventory 76 days on average. Payment turnover. First of all, we should calculate all purchasing of inventories like API plus expenses divided by average payables. To calculate average purchasing inventory, I have to do something. First of all, I should use cost of goods sold minus and minus beginning of the inventory plus ending inventory of course. Do not forget to consider depreciation. Yes, and look at that. This is all purchasing of inventory. And now all purchasing of inventory plus expenses cost. You should use minus because the expense already minus divided by average payables from balance sheet. Plus, sorry guys, plus other payables plus trade payables for 2014 plus other payables for 2014 divided by 2 to find the average payables with additional parentheses. Yes, that's it. And average payment period is 365 days divided by payment turnover ratio. If you look at that, it's declining. While average collection period is increasing, average payment period is declining. Do you think it's a good thing for the company or the bad situation? We will need a cash to extra finance for this deficit, financial deficit. And to calculate financial deficit is we will need an additional formula that to find it. Average payment period minus average inventory days minus average collection period. This is 53 days for 2014. For 2015 is 64 days, and the last year is 76 days. You can say that the financial deficit stays year by year is increasing against the company. And fixed asset turnover, sales divided by average fixed assets. This ratio is a rough measure of the productivity of a company's fixed asset, like property, plant, and equipment, with respect to generating sales. Increasing of its proves that the company enhances its productivity. Fixed assets sales divided by average fixed assets or non-current assets divided by 2. Sorry. It's a good thing that it's increasing. I can say small, maybe not a big fixed asset investment provides the company more sales. And equity turnover, sales divided by average equity, again sales divided by average equity. Wait, you. Yes. It's increasing like same as fixed asset turnover. And the next one is profitability ratios. This section measures of the corporate profitability and financial performance. Gross margin, gross profit divided by sales. Gross profit, where is gross profit? Sales minus cost of sales is gross profit divided by sales. It's decreasing. It's decreasing. Operational profit margin. Operational profit divided by sales. It is again declining. Net income margin, net income divided by sales. Net income divided by sales. Yes, it's dramatically decreasing. And EBITDA mean earning before interest, tax, depreciation, and amortization. Or I can say earning before tax, interest, or finance expense, and depreciation. It's slightly increasing, but to look at the EBITDA margin, EBITDA divided by sales, we will see the probability. Unfortunately, it's decreasing. And the next one, return on assets. Mean net income divided by average assets. Net income divided by average assets. Plus, like that, divided by 2 to find the average one. And parentheses on it. And return on equity. Net income divided by average equity. if you look at the bright side for these two ratios, despite increasing loan, company keeps its profit. And financial ratios, the last one. These ratios give users a general idea of the company's overall debt load as well as its mix of equity and debt. Debt ratios can be used to determine the overall level of financial risk. Debt ratio is total liabilities divided by total assets. Total liabilities short term plus long term divided by total assets. And for instance, in 2014, 56% of assets were financed by debt. And this rate is increasing, means company needed more debt to finance its investment, maybe its customer, or maybe its shareholder to distribute a dividend. We will see next step. We will see it next step. And equity ratio, total equity divided by total assets. Divided by total assets. Of course, these ratios totals must be 1. And equity level for the assets is decreasing year by year. And look at the last year. The assets were financed by the third-party loan. The rate is 66%. And shareholder financed the company with 34 rate. This rate is not a good rate, especially for manufacturing company. We need more equity, more profit. Short-term ratio, short-term liabilities divided by assets. Company's short-term, very important ratio that. Look at that. Sorry guys, something wrong. Liabilities divided by, oh my god, for last year company's assets were financed by short-term liabilities with 33%. How can company survive with this ratio? I don't know, in the future. Bank loan ratio. And something going bad year by year. Almost all ratios provide us the same results. Bank loan ratio, total bank loan. You know, bank loan is very important. It's difficult to delay. Maybe trade payables can be delayable, but bank loan is the most difficult part to delay or not paying. It's difficult. You have to pay. Or you can see the banker in front of your door to have your company. Total bank loan divided by total assets. %43 of the assets were financed by bank loans. It's an incredible ratio. And fixed asset ratio. fixed assets divided by assets. Fixed assets is a very important part of the assets. Non-current assets divided by total assets. It must be more than 50%. The recommendation is at least 60% for manufacturing company. And fixed asset must have to be financed by long-term debt and equity, not short-term liabilities. And fixed asset ratio is fixed asset divided by long-term liabilities plus equity. Divided by long-term plus equity. If you look at the last year, it means fixed assets total is more than, as an amount, more than long-term liabilities plus equity. I mean, the last year fixed assets were financed by short-term liabilities. But fixed asset you will use for a long period. You will produce something, then you will sell and you will collect it. And the return on fixed asset is a long period, but in this case you have to pay within 1 year. How can you pay? You can't pay with sales. You can pay the short-term liabilities with taking additional liabilities. And guys, I've completed all ratios, and I would like to share a chart using something on balance sheet and P&L statements. These are sales, cost of goods sold, trade receivable, fixed assets, and bank loan provided by the financial statements. Look at, for example, bank loan for 2013, 3,500,000 total bank loan. Sorry, yes. And I would like to prepare a trend analysis. If I say 100 for first year, I would like to see the trend for year by year to see increasing rate for each one. And if I transfer this value into a chart, the result is like that. It is the summary of what's going on actually. The bank loan dramatically increased with a trade receivable. Cost of goods was rise more than sales, and sales did not increase as much as trade receivable. In other words, collection period extends. We will see that already here, like that, collection period. We can also say that new investments affected sales positively as well, as a good thing. Because sales increasing more than fixed assets increasing. And as a conclusion, company invests on fixed asset to increase its sales, but cost and expenses rise more than sales increasing. Besides, while collection period increasing, payment period declined. So financial deficit comes to, look at that, comes to 76 days from 53 days. The company's additional loan from bank to finance these 76 days. gap. If you look at the retained earnings, it increasing slightly despite income company earned year by year. Despite almost $5 million cumulative income, retained of the year 2016 is $1,045,000. Company could have used its income to finance its deficit and investment rather than distributing its income to shareholders. It should have improved its collection method and sales strategy as well. Thank you for listening.